For the most part, when people are investing in bonds, they are buying shares of a bond fund or ETF. Similar to a stock ETF, these funds own a portfolio of different bonds, often including a mixture of US Treasuries as well as corporate bonds. This gives you the benefit of having diversification across different types of borrowers, all with different risk associated with them. Bond funds can also offer you domestic exposure, which is limited to the United States, or international exposure, which gives you a mix of bonds from across the entire globe. One of the most popular bond funds out there is BND, the Vanguard Total Bond Market ETF. This fund owns over 11,000 different bonds with an average maturity of 8.5 years. In terms of the asset mix, roughly 2/3 of the fund is invested in US Treasuries or government bonds, with the remaining 1/3 invested in a mix of corporate bonds. Based on the creditworthiness of the company, they are assigned a letter rating, and this is similar to an individual borrower having a credit score. AAA bonds are considered to be the lowest risk, and that's like having an 800 plus credit score, for example. Then it works down from there to the AA's, the A, BBB, and so forth. Now, bonds that are rated at a BBB or better are considered to be investment grade bonds, meaning that they are viewed as having a lower risk of default and worthy of investment. Below BBB, you have what's called junk bonds. They have a lower credit rating, they do pay a higher rate of interest, however, the risk of default is higher. That would be like loaning somebody money with a credit score in the 600s. They're gonna pay a higher rate of interest, but there's definitely some risk involved with the repayment. With BND, the Vanguard Bond ETF that I just showed you, all of the corporate bonds owned are investment grade, having a rating of BBB or better.